Hello and welcome to AI Market News by LM. Before we dive in, a quick disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in the summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, so it's Monday, September 1st, 2025. And while many of us here in the U.S. are observing Labor Day, global markets, well, they're definitely not taking the day off. Today, we're aiming to go a bit deeper than just the numbers. We want to explore, whether these subtle shifts we're seeing in futures and currencies are maybe signaling something new for global markets, or perhaps if those underlying anxieties about global trade and geopolitics are still really holding things back. We'll unpack the latest in global currency pairs, take a look at U.S. equity markets, and of course, the key economic indicators influencing them. So even with the U.S. markets technically closed for the holiday, let's start there. How did U.S. equities finish last week, and what are futures telling us about the week ahead? It felt a bit, mixed, didn't it? Closing out August.
Yeah, mixed is a good word for it. That's a fair assessment. If we look back at Friday's close, the Dow Jones, it dipped slightly, 0.2%. The S&P 500 was down a bit more, 0.64%. And the NASDAQ actually took a bigger hit, falling about 1.15%.
Right.
But here's where it gets interesting. Despite that pullback on Friday, U.S. futures are actually sort of setting things up for what could be a fourth straight month of gains for the S&P 500.
Really? 4 months?
Yeah, and this morning, even with the holiday, futures for the Dow, the S&P, the NASDAQ 100, they're showing slight gains. We're talking around plus 0.04% to maybe plus 0.10%. So a little bit of green there.
Yeah.
It's also worth remembering the historical context, right? Various news commentary often reminds us that September, statistically, it's the weakest month for U.S. stocks.
Oh, yeah, the September effect.
Exactly. The S&P 500 has, on average, fallen something like 56% of the time during September.
Yeah.
It's often linked with, slower buying activity. And looking at individual stocks last week, we definitely saw some downward moves. NVIDIA was down 3.32%, Tesla fell 3.50%, and Dell saw a pretty significant drop, 8.88%.
Ouch. It's not quite a hit for Dell and some big tech names. But then you had Alibaba, I saw that nearly 19% surge, all on AI revenue.
Yeah.
That really seems to point towards that two-speed Chinese economy idea, doesn't it? One part struggling, but another part just rocketing ahead with AI.
Precisely. That Alibaba surge is, I think, a really striking example of that two-speed dynamic in China. You've got AI innovation just powering forward, even while other, maybe more traditional sectors might be finding it tough.
Mm-hmm.
It really highlights how investors are, finding these strong micro trends, even within regions facing broader challenges. So, yeah, August closed kind of subdued for some, but there's this cautious optimism in the futures this morning.
Okay, so that brings us to the underlying sentiment. Are investors feeling more fearful or greedy as we head into this historically weak September?
Yeah, good question. And that's where the CNN Fear and Greed Index is super useful. It gives us that kind of emotional temperature reading of the market. Now, it pulls together several factors, right? Things like market momentum, the put-call options ratio. But the main point is its current reading. And if you pair that with the VIX, the volatility index, which is noted as being about 20% below its one-year average.
Oh, interesting.
Yeah, it suggests maybe less immediate fear in the market despite those recent pullbacks we just talked about.
So it's a nuanced picture then.
Exactly. It's nuanced. Wall Street closed out August kind of quietly, but at the same time, we're hearing reports that American consumers are still spending, even with inflation being elevated. So it paints this complex picture of both investor and consumer confidence, really.
Okay, a subtle mix of maybe apprehension and resilience in the U.S. equity space. But what about globally? Let's shift to the currency markets. They often give us those early signals, don't they? What's happening with the major pairs?
Yeah, definitely worth watching. Looking at the majors this morning, September 1st, the euro versus the U.S. dollar, Euro USD, is trading around 1.1719. That's up a bit, about plus 0.29%.
Yeah.
The U.S. dollar against the Japanese yen, USD JPY, is at 147.12, just a tiny increase, plus 0.05%. What's particularly interesting, I think, is the Japanese yen's trend overall. It actually gained against the U.S. dollar last month.
It did, okay.
Yeah, and that movement, coupled with all the ongoing talk about a potential Bank of Japan rate hike, well, it could lead to some unexpected outcomes for the yen's strength down the road. We'll have to see. Meanwhile, the U.S. dollar index, it's currently sitting at 97.575. That reflects a small dip, about 0.12%. And actually, the U.S. dollar finished August in the red for the whole month.
Right, you mentioned that negative return. That's definitely something to watch.
Absolutely. It's a trend we need to keep a close eye on. And, for folks looking for deeper insights into these FX dynamics, platforms like ONDA offer some really valuable tools.
So your order books and things.
Exactly. Things like order books, currency strength charts. They can really help visualize that underlying market sentiment and potential price moves. Gives us a clearer picture of where currencies might be headed.
Okay, so the dollar weakened in August, yen showing some surprising strength. Now, beyond these day-to-day market moves, the big picture stuff, the macro landscape, central bank policies, that's critical for setting the overall tone. What's the latest there, especially from the U.S. Fed perspective?
Right. That's where we need to look ahead. The FedWatch tool from the CME Group is pretty essential here. It helps us track the market's perceived likelihood of rate moves by the FOMC based on Fed funds futures prices. The next big meeting for the FOMC is scheduled for September 17th, 2025.
Coming up soon, then.
Yeah. And the general feeling seems to be that policymakers are leaning towards starting rate cuts in September. We've seen bets increasing on a September cut, definitely influenced by comments from Fed officials, including Chair Powell's remarks back at Jackson Hole.
Okay, leaning towards cuts. What's the key data point we should be watching?
Well, the huge one is this Friday, September 5th. That's the non-farm payrolls report for August. The market's expecting a figure around 75,000 jobs added, but analysts are warning about extreme sensitivity around this number.
Extreme sensitivity, meaning?
Meaning any big surprise, significantly higher or significantly lower than that 75K expectation, could really disrupt the Fed's thinking and that perceived lean towards cuts. It could shake things up.
Got it. So NFP Friday, then what else?
The next week, we got the CPI data coming out that's crucial for inflation, obviously, and also the ISM report, the Institute for Supply Management, which gives us clues about the health of the U.S. economy. Oh, and Treasury yields. Right now, the 10-year is at 4.227%, the 30-year at 4.917%, and the 5-year at 3.699%.
Yeah.
We actually saw the 2-year note have its biggest rally this year recently, which suggests people are really pricing in a more aggressive Fed easing cycle.
That's fascinating about the 2-year yield. So a lot riding on this upcoming U.S. data. You mentioned that extreme sensitivity around the jobs report. Given that apparent lean towards cuts, how much do you think a really unexpected NFP number, say, way higher or even negative, could genuinely derail that September meeting? Or are they kind of already set on cutting?
That is the million-dollar question, isn't it? Look, while the narrative for a September cut seems pretty strong right now, a major shock in the non-farm payrolls. Yeah, it could absolutely force them to rethink.
Like 200,000 jobs added or maybe negative?
Exactly, something like that. Strong job growth might make them think, maybe we don't need to ease just yet, while a sharp drop could signal deeper economic trouble. Either way, it could definitely shift market expectations. I mean, they're not fully committed until they actually meet, and these big data points are their main inputs.
Makes sense. Okay, what about globally? ECB, BOJ.
Right, globally, the ECB's next meeting is September 11th. And Euro area inflation data is actually due out tomorrow, September 2nd. That'll be interesting because some of the national inflation numbers from Spain, France, Germany, they came in a little higher than expected in August.
Okay, so watch that tomorrow.
Yeah, and ECB President Lagarde is also scheduled to speak today, so maybe some hints there. Then the Bank of Japan, their next meeting is September 19th. Now, the market is pricing in about an 85% chance of a tiny, tiny hike, like 1 basis point, 0.01% by the end of the year.
Just 1 basis point.
Yeah, barely anything. But even so, there's skepticism among some experts about whether they'll actually hike in October or even by year-end at all. Counterbalancing that a bit, though, was some strong Japanese capital expenditure data. It came in at 6.1% growth, which was better than expected. So that's a key factor for the BOJ to consider.
And manufacturing data, I saw some PMIs came out today.
Yes, various manufacturing PMIs across Europe and Asia were released. Remember, above 50 generally means expansion. So Spain looks strong at 54.3. Italy and France were just above 50 at 50.4. Germany, however, dipped slightly below 50 to 49.8. That indicates contraction in the Eurozone's biggest economy, so that definitely bears watching.
Germany contracting is noteworthy.
It is, though the overall Eurozone aggregate was just barely in expansion at 50.7. Also, South Korea's CPI for August, year over year, came in at 2.0%.
Okay, so Germany's dip into contraction is a flag, even if some others showed resilience. Let's widen the lens again now to that broader global economic picture. Geopolitics always seems to be throwing curveballs, shaping regional dynamics.
Absolutely. And one fascinating ongoing story is the U.S. tariffs situation. There was a significant development on August 29th. A U.S. appeals court ruled that Trump's global tariffs, the ones based on emergency powers, were actually illegal.
Illegal, but they're still in place, right?
Exactly. They remain in place for now because the case is being appealed to the Supreme Court, so it creates this kind of state of limbo. The administration has choices, appeal, find other legal ways. It's complex. And remember, this whole legal fight stems from tariffs that were originally meant to help pay for a massive $3.4 trillion bill.
Wow. Okay, what about China? You mentioned the two-speed economy.
Right. Well, the broader picture, China's factory data for August is still stuck in contraction. That's partly due to government crackdowns on price wars. Home prices have also fallen, and apparently, fresh stimulus for major cities like Beijing and Shanghai has been ruled out.
So headwinds there.
Definitely. But again, contrast that with the Alibaba surge we talked about, nearly 19% on AI revenue. It just underscores how this AI boom is carving out a really distinct growth sector within China, even with those broader struggles. And related to AI growth in Asia, OpenAI is also planning a big data center in India.
Interesting. Now, you mentioned Japan earlier, strong CapEx data. It sounds like Japan might be emerging as a more compelling alternative for investors, especially maybe compared to stretched U.S. valuations.
That's definitely a narrative gaining traction.
But isn't the skepticism around a BOJ rate hike by year-end kind of a headwind for that story?
That's a very fair point. And it highlights a tension in the market, for sure. While the BOJ's cautious stance on rates is a potential headwind, the appeal of Japan isn't just about immediate rate hikes or purely macroeconomic growth.
So what else is driving it?
Well, we saw that strong capital expenditure data, 6.1% growth, showing businesses are investing. Plus, you have these other maybe more structural factors people are looking at, things like the sense that deflation might finally be ending, changes to corporate takeover rules making things more dynamic, and just generally capital looking for places to go outside potentially overvalued markets, like shifting into riskier assets globally. So these elements, combined with those potentially stretched U.S. valuations, make Japanese equities look attractive from a different perspective, even if the central bank isn't moving rates aggressively just yet.
Got it. A different angle on Japan. What about emerging markets more broadly? Still a favorite long-term bet.
For a longer-term view, say 5-10 years, EM is often cited as a favorite bet, yes. They're generally significantly cheaper than U.S. equities and potentially offer better earnings growth prospects.
But there's always a but, isn't there?
There often is. We absolutely have to acknowledge the political instability risks in some regions, particularly, say, Southeast Asia right now. For example, Indonesia has seen quite a bit of public anger and protests over rising living costs and also lawmaker allowances. It actually led the president to scrap some controversial perks.
And that hit the market.
It did. Their main stock index slipped about 1.5%, and the Bank of Indonesia had to step in to stabilize the rupiah. So, real consequences. Thailand is also facing pretty intense political jostling after their prime minister was ousted. These things matter.
Absolutely. And Europe. Any specific challenges there beyond the German PMI dip?
Well, France is definitely one to watch. Political turmoil is ongoing there, with a confidence vote expected on September 8th. And this uncertainty has led to French bond spreads widening significantly. They're approaching 80 basis points over German bonds now.
So, investors demanding much higher returns to hold French debt compared to German debt.
Exactly. It signals rising concern about France's fiscal situation. The market is questioning their long-term plan for growth and getting their deficit down. It's currently around 5%. There's even talk that French spreads could potentially go wider than Italy's, which is striking given France has a higher credit rating. It just really underscores the depth of concern about fiscal discipline there.
Wow, France wider than Italy. That would be something.
It would. And of course, the UK is still grappling with inflation that seems stuck near 4%. So yeah, these interwoven global factors really highlight the complex landscape we're all trying to navigate right now.
What an incredibly detailed tour of the global markets. Seriously, from that intricate dance of currencies to the underlying emotions driving stocks and all those crucial macro indicators on the radar, it's just so clear that staying informed and, frankly, agile is key for us. Whether it's these subtle shifts in central bank language or the bigger geopolitical ripples hitting trade, every single piece of this global puzzle really does matter, doesn't it?
It really does. It underlines just how interconnected everything is.
Today's insights really bring that home.
Absolutely. We've tried to highlight the key events and the data points that are really shaping the financial landscape right now. And looking ahead, that economic calendar is just going to remain a vital guide. As always, for a detailed schedule of what's coming up, NFP, CPI, central bank meetings, we can always refer to investing.com. They usually have a very comprehensive list.
Great tip. Okay, that wraps up our deep dive for today. Thanks for watching. Don't forget to like and subscribe.